Here's something I see almost every founder do. You open your profit and loss statement or P&L. Your eyes shoot straight to one number, the sales figure at the top or the profit at the bottom. You get a little jolt of relief or a little knot of dread, depending on what you see, and then you close it again. Done. A CFO does something completely different. They read 5 numbers in about 30 seconds, and they know exactly how your business is really doing and where it's heading. By the end of this video, you'll read your own P&L the same way. In under 10 minutes. No accounting degree required. And stay to the end, because the 5th number, the last one I'll show you, is the single number that predicts whether your business will be here in 12 months. It's not your revenue. It's not your profit. And most founders never look at it. I'm Nyasha. I'm a chartered accountant, and I've also built and run my own business over the last 5 years. So I've read these statements from both sides of the table. Let's get into it. A profit and loss statement, also called an income statement, is just a story told in 3 acts. Act 1, what you earned. Act 2, what it cost you to earn it. Act 3, what's left over. Top to bottom, what you earned, what it cost, what you kept. That's the whole document. And here's a detail that matters more than it sounds. A P&L always covers a period of time. Could be a month, a quarter, or a year. So the very first thing to check when you open a P&L is which period you're looking at. A monthly P&L tells you how that 1 month went. An annual P&L sums up the whole year. Keep that in your back pocket, because when we get to the balance sheet in a future video, it works completely differently. That's a snapshot of a single moment in time, not a stretch of it like the P&L. Now, the term earned trips a lot of people up, so let me make it simple. You earn money the moment you do the work or hand over the product, not when the cash actually lands in your bank account. Finish a project in June, but the client doesn't pay until August. That sale still counts in June on your P&L, because June is when you earned it. Same with costs. If a freelancer does work for you in June, that's a June cost, even if you only pay them next month. So your P&L shows you what you earned and what it cost you, not the cash going in and out of your bank account. And that gap between earning the money and actually getting paid is exactly why profit and cash are 2 different things. But that's a whole other video. The P&L is not an accounting exam. It's a scoreboard. It answers exactly one question. Does your business actually make money the way you think it does? Most founders assume the answer is yes. The P&L is where you find out for sure. So as we walk through the 5 numbers, just read top to bottom and follow the story. Number 1, revenue. The top line. Every sale you made before any costs come out. It's the number everyone fixates on, and it's the number most likely to lie to you, because on its own, it tells you nothing about whether you actually made money. I've watched founders celebrate a record sales month and quietly panic about payroll just 2 weeks later. That's the profitable on paper, broke in reality trap. Revenue without context is just vanity. So a CFO doesn't look at the total. They look at the trend and the mix. Is the revenue growing or flat? And where it's coming from? Your best clients or a pile of low-value work that's keeping you busy and broke? And the biggest question in that mix, how much of your revenue is recurring versus one-off? Recurring revenue repeats. A retainer, a subscription, a client on an ongoing contract. One-off revenue is a project or sales you have to go out and win all over again next month. 100,000 in recurring revenue is worth far more than 100,000 of one-off work, because you can actually count on it. You don't just ask how much you earned. Ask how much of it will show up again next month without you having to chase it. Revenue is where the story starts, never where it ends. Number 2, your gross profit and its percentage version, which is your gross margin. In plain English, take your revenue and subtract only the costs directly related to delivering the work, the things you wouldn't spend money on if you didn't make the sale. On your P&L, these are usually grouped under a line called cost of sales. You might also see it as cost of goods sold or COGS. They all mean the same thing, your direct costs. For an agency, that's your contractors and freelancers. For a product business, it's your materials and shipping. What's left after you subtract them is your gross profit. Divide your gross profit by revenue, and you get your gross margin percentage. Let's go through a quick example. Say you did $500,000 in revenue and delivering that work cost you $200,000. This makes your cost of sales $200,000. Your gross profit is thus $300,000, and your gross margin is 60%. That 60% is the true engine of your business. It's how much of every dollar you keep to run the company and make a profit. And hold on to this number, because it's going to come back at the very end as the most important number of all. Remember, 60%. Number 3, operating expenses or overheads, the costs of running the business that aren't tied to delivery. So you have these expenses whether you make a sale or not. Rent, software, your core team salaries, marketing, the accountant. Individually, they look harmless. A subscription here, a hire there. But overheads creep, and that's what makes them dangerous. So what's the CFO move? Never look at overheads as a dollar figure alone, always as a percentage of revenue over time. So if revenue grows 20%, but overheads grow 40%, you're getting less efficient as you get bigger, and you won't feel it until it hurts. So the question isn't, can we afford this expense? Is our overhead growing faster than our revenue? The moment the answer is yes, that's your signal to act. Write that down. Number 4, operating profit. Take gross profit, subtract operating expenses, and you get the profit from your core business before interest and tax. Some people call it EBIT. Here's why CFOs trust it more than the bottom line. Your net profit, the very last line, gets distorted by things that have nothing to do with how well the business runs. A tax adjustment, the interest on your loan. Operating profit strips that noise out and answers a clean question. Does the thing you do every day actually make money? If operating profit is healthy, but the bottom line is messy, your business is sound, you might have a financing issue to fix. If operating profit is thin, the model itself needs work. That distinction is gold. Number 5, the survival number. Here's the one I promised right up front. The single number that predicts whether you'll still be here in 12 months. It's not your net profit. Net profit tells you about the past. What has already happened? The number that predicts your future is the trend in your gross margin. That percentage from number 2. Here's why. Remember our 60% margin. Now imagine next year you grow. Revenue jumps from $500,000 to $750,000. Founder's dream, right? But your margin slips to 48% because you discounted to win deals and delivery costs crept up. On paper, you're bigger. In reality, you're driving towards a cliff. Every new dollar of sales now keeps less. So scaling multiplies the problem instead of solving it. Let's flip it. If your margin holds or climbs as you grow, you can scale safely. Growth makes you stronger. That's the whole game. So here's what to do this week. Pull your last 3 P&Ls. Calculate gross margin for each. Remember, that's gross profit divided by revenue. Line those three percentages up and look at the direction. Rising or steady, you're building something that scales. Falling, you've just caught a problem months before it would have shown up in your bank account. That trend line is your early warning system. Most founders never look at it. Now you will. So there's your CFO read top to bottom in about 10 minutes. Revenue, the story starts. Don't trust it alone. Gross profit and margin, the true engine. Operating expenses, watch them as a percentage, not as a number. Operating profit, does the core business work? And then the trend in your gross margin, your 12-month early warning system. Once a month. That's the whole ritual. If this gave you that, oh, I should already know this feeling, you're exactly who I make these for. Subscribe for more of these, and I'll see you in the next one.